Today, we are digging into a number that, it's just staggering, 87%.
Yeah.
That's the crash that MREO Biopharma Group, ticker MREO, saw in one single trading session.
It was just a bloodbath. Absolutely instantaneous. The price went from over $2, I think it was $2.31, down to what, around 29 cents?
Something like that. For anyone holding that stock, that's a day of just pure panic. The definition of blood in the streets.
Exactly, and that's why we're looking at it.
Right. That extreme fear is exactly what the analysis reports we've got here are focused on. They're suggesting this historic crash created a massive a dislocation.
A market error.
Exactly. So our mission today, just to be clear, isn't to find a long-term biotech winner. It's to look at a high-risk, deeply contrarian trade based purely on the numbers left behind after everyone else ran for the exits.
And we can get to the core thesis right away because it's just so rare. The analysis calls this a negative enterprise value situation.
And that's a critical term.
It is. It means the market, in its panic, is valuing the entire company for less than the cash it has sitting in the bank. It's effectively saying the cash itself is worth less than face value. That's an anomaly that only happens when fear just completely takes over.
Okay, so let's start at the beginning. The catastrophe. Why did MREO drop so hard so fast? This wasn't a slow bleed.
No, it was a cliff dive. And it comes down to Wall Street pricing the stock for perfection. You have to remember how these small biopharma companies are valued. It's all about the future.
The drug pipeline.
It's a pipeline, exactly. MREO's main asset was a drug called setrusumab. It was in a huge, pivotal phase 3 trial for brittle bone disease.
So the whole company's value was basically riding on this one drug trial succeeding.
Pretty much. The market had priced it in as a success. All the future revenue, all the hope, it was already in the stock price.
And then the catalyst hit.
The catalyst. The announcement that the phase 3 trial failed to meet its main goal, which was reducing fracture rates. That one piece of news just shattered the entire story.
And when you price for perfection and you get, failure, the algorithms don't really stick around to ask questions, do they?
No, they don't think. They just sell. They dump the stock instantly, and that's the firestorm we saw. So for you listening, this is really important. The long-term growth story is broken. It's over for now.
Yep.
We have to shift our focus completely. We are now talking about a short-term trade based on a mathematical mispricing. That is the only reason we're having this conversation.
That pivot is everything. Okay, so let's get right into the data that suggests this isn't just a dead company, but a math problem. The core bull case.
Yeah.
Trading below cash.
Right. This is the theoretical safety net.
Yeah.
And we have to look at the numbers from the reports. As of their last filing, Q3 2025, MREO had about $48.7 million in cash on hand.
Okay, $48.7 million.
In the bank.
In the bank. Now, after the crash, with the stock trading around, say, 29 cents.
The whole company, the market cap, was worth what?
Only about $45.5 million. Okay, wait. Let's just let that sink in for a second. The company has $48.7 million in cash. But the entire market says the company is only worth $35.5 million.
Yeah. You're buying a dollar's worth of cash for about 93 cents.
That's not just a discount on the business. That's a discount on the liquidity.
It is. And the analysis is really clear on this point. The market is assigning zero value, actually negative value, to everything else. The technology, the staff, the patents, the partnership with Ultragenics.
All of it.
All of it is being valued at less than zero. You are literally getting paid to take the company, assuming you could just liquidate the cash.
It feels like pure behavioral finance in action. Panic has just completely overridden the fundamentals. So if the market is that panicked, the technicals must look awful. Completely oversold.
Oh, absolutely. The analysis points to the relative strength index, the RSI. It measures how fast a stock has moved. Anything under 30 is generally considered oversold.
Yeah, and for MREO.
It's basically at zero. On the daily chart, it's just completely floored.
No.
It indicates a level of selling pressure that has just washed out almost everyone.
And this is where the market mechanics get interesting, right?
Okay.
Because when a stock drops 87%, a lot of short sellers just made a huge amount of money.
A fortune. And at some point, they have to lock in those profits. They have to cover their shorts.
Which means they have to buy back shares.
They have to buy. And that buying, even if it's just technical and temporary, can cause a really sharp, fast bounce. That's the immediate opportunity the analysis is pointing to.
And it's not just a technical theory. If you look at what Wall Street analysts are saying, even after the crash, their lowest price targets are still way above where the stock is trading.
They are. You have firms like BTI, Baird, they all slashed their targets, of course. The growth story is gone. But even their most conservative post-disaster target is $1.
$1.
$1. They're still assigning some value to the remaining assets and the IP, unlike the market right now.
So let's just do that math for everyone. If the stock is at $1.29, getting to that lowest Wall Street target of $1, that's a potential upside of over 240%.
244%, yeah. That's the potential reward side of this very, very high-risk equation. It's not about a new drug, it's about a reversion back toward just the tangible value of what's left.
I have to play devil's advocate here, though. That $48 million cash pile sounds great as a safety net, but what's to stop management from just burning through it?
That is the single most important question, and it's the biggest risk. The whole strategy in the analysis assumes that management acts rationally, that they see the writing on the wall and immediately start cutting costs.
Layoffs, shutting down expensive research.
All of it. To preserve that cash floor. If they don't, this entire thesis just falls apart.
Okay, so let's talk about how the analysis suggests actually trading this. The entry points, the targets, and crucially, the stop loss.
Right, because it's so speculative, the parameters have to be really tight. The suggested entry zone is somewhere between 20 and 30 cents.
The cash floor.
Exactly. That's the zone where you're buying the company for as close to its raw cash value as possible. It's where the math gives you the most protection.
And the targets are split into two different ideas.
They are. Target 1 is just a technical bounce, a scalp. You're aiming for the 45 to 50 cent range.
So quick in, quick out.
Super quick. You're just playing for that short covering rally we talked about. A potential 50, maybe 70% gain based on market mechanics alone. Not on any fundamental change. It's the faster, maybe safer bet.
But what if the market actually wakes up and realizes it's buying cash at a discount?
Well, that's target 2. That's the value reversion play. It's aiming for 75 to 90 cents.
Okay.
That move would require more than just short covering. It would need some actual buyers to step in, recognize the negative enterprise value, and push the price back towards its book value. Much higher reward, but it requires more patience.
And for a trade this volatile, you absolutely have to know when you're wrong. Where's the line in the sand?
The stop loss is critical. The analysis suggests a close below 18 cents.
Okay, $2.18.
If it goes below that, it means something is systemically broken. It means the cash burn is way worse than we thought, or management is doing nothing, and that whole cash floor safety net is gone.
And that leads right into the biggest risks here. The cash burn is real.
It's the number one risk. That $48 million is not infinite. This company has salaries, rent, lab fees. If they don't slash costs, that cash pile shrinks every single day. The faster it shrinks, the lower the floor drops.
And what kind of stock is MREO right now? Let's be blunt.
It's a penny stock. Full stop.
Okay.
This is not a safe buy and hold investment. You have to expect insane volatility. Wild price swings on almost no news. This is for high-risk capital only.
And there's another risk, right? The longer it trades down here, the more structural problems it faces.
Yeah, the delisting risk. Trading under $1 for an extended period puts you on NASDAQ's naughty list.
Yeah.
Get a non-compliance warning. Now, that whole process takes months to play out, and there are ways around it.
Like a reverse stock split.
Right. But for you, the person trading it, it just adds another big layer of uncertainty.
Okay, so let's tie this all together. We started with this massive 87% crash, a total clinical failure, but the analysis uncovered a potential trade based on a mathematical error. What's the core conflict here?
The conflict is between a bad company story and a mispriced asset. They might not have a great future, but when a stock is trading for less than the cash in its bank, the downside is, at least in theory, mathematically limited.
Provided they stop the bleeding.
Provided they stop the bleeding. Meanwhile, the upside, even just a bounce back to those lowered analyst targets, is huge. It's one of the purest buy the fear setups you'll ever see.
And I think we have to say that again for everyone listening. Is MREO a long-term hold, a bet on the future of biotech?
Probably not. Not based on what we know. The analysis frames this as a short-term technical trade. It's about market panic and math. It requires discipline, and it's all about that rebound potential.
A market saw a disaster, but the analysis is screaming pricing error. So for anyone watching this, the analysis leaves us with one final thought. Keep your eyes glued to the 30-cent level. That's the immediate battleground. If the stock can hold firmly above 30 cents, that suggests the bulls are trying to make that first move, up toward that 45-cent scalp target. But if it struggles there, if it slips back below, it means fear is still in control, and we could be heading back down to test that deep value entry near 20 cents. The whole market is watching to see if 30 cents can hold the line.